Hello and welcome everyone to Safe Agreements 101. SAFE stands for Simple Agreement for Future Equity. We're really excited to have you here. My name is Alex Cox-Cuzzy, and as a programming board member of the Venture Capital and Funding Programming Board with StartOut, I'd like to provide a brief overview of StartOut before we dive in. StartOut is a US-based nonprofit organization founded in 2009, that focuses on supporting LGBTQ+ entrepreneurs and startup founders. Our mission is to increase the number, diversity, and impact of LGBTQ+ entrepreneurs, and also to amplify their stories, ultimately to drive the economic impact of the queer community. Over the past 10 years, we have built a community of 17,000 members, and we support 300+ entrepreneurs every year. In essence, StartOut is about networking, entrepreneurship, and community. If you are a founder, we provide you with direct individual support through community events, one-on-one mentorship, one-on-one office hours with experts, a 6-month accelerator program, and investor connections. A special shout out to our community partner for this event. We've got Orrick, Herrington, and Sutcliffe. They are sponsoring this event. We've got one of their employees with us who I will introduce momentarily. And they have been partners with StartOut for quite some time now. And we've really been honored to have them as a part of our community. So a little housekeeping. StartOut will be managing the chat today, so please feel free to introduce yourselves and chat with the fellow attendees. All panel-specific questions should be submitted in the Q&A section. So you'll see that we have 2 sections. We have a chat, we have a Q&A. Questions in the Q&A, and then you can chat and introduce yourselves in the actual chat section. My name is Alex Cox-Cuzzy, and I work at SMBX, which is a crowdfunding platform that focuses on debt investing. And I have been on the programming board for this past year, and it's been an incredible experience. And there's a lot of volunteer opportunities with StartOut that I highly recommend looking into and getting involved with this organization. And now, I would like to present our speaker. Mike Sullivan is the head of the San Francisco corporate group at Orrick, Herrington, and Sutcliffe. And lucky for us, a longtime member of StartOut's board of advisors. Mike has been a startup and venture capital lawyer for over 25 years, helping hundreds of entrepreneurs with their startups and working with top investors and venture capitalists and providing financing to emerging companies. He works with companies and investors across many verticals, including information technology, consumer, life sciences, and healthcare, and wine and spirits companies. We are delighted to have Mike share his knowledge and experience with us tonight. It is truly just going to be an excellent presentation, and I'm super excited about it. All right, so I am actually going to stop sharing my screen, and then Mike is going to share his screen and get started.
All right. Thank you, Alex. And yes, I'm not only going to share information, I'm going to share my screen. Let's see, make sure this works. Can you see, Alex? Is that looking good?
Looks great.
Great. So I'm going to talk tonight about the SAFE, which was really a game changer for startup companies and entrepreneurs. In the bad old days, which is pre-2013, it was very complicated to raise money, the early money, when startups needed to raise money. And the invention of the SAFE in 2013, I believe, was really a big development for the startup community. And so I'm going to take you through what a SAFE is, how it works, the different flavors of SAFEs, and at the end, I'm going to talk about some things to do and not do, sort of tips for entrepreneurs trying to work with this security. All right. So just a few basics. The safe was invented by Y Combinator in 2013. Y Combinator is the most, I would say they're the biggest market presence as a helper to startups, a huge market presence. They invented it in 2013. Orrick was actually involved. We have partnered with Y Combinator in a lot of their work over the years, and we work with them to pull it together. In fact, my partner, John Batista, actually came up with the name, Simple Agreement for Future Equity, or SAFE. As I said a minute ago, safes are an extremely simple way for startups to raise money, and they're very founder friendly. In fact, they're so founder friendly that some of my investor clients are not so happy with us that we helped Y Combinator invent the safe, because it's not as good for investors. So safes are a type of what we call a convertible security. So investors invest money now with the startup, and they only get the stock later. The safe converts to stock later when the company does a real financing, typically with venture capitalists. And until then, the investor doesn't really know how many shares they're going to get. We'll talk about that a little bit later. The safes are very well accepted in the tech world, in the Silicon Valley, air quotes, Silicon Valley world. Very well understood. Everyone seems to know what a safe is in the tech world. Outside of that ecosystem, they're not so well known. And investors in other parts, not only other parts of the country, but other worlds. If you're not in tech, if you're a restaurant owner or other non-tech company, you may find safes that your investors are not so familiar with them, and there may even be resistance to using safes. So a safe is in its simplest form, a safe is a convertible note, but it's better for founders. Before safes, startups usually raise their money with convertible notes. And a convertible note is a promise to pay your investor. The notes had a maturity, so they had to be paid back at some point, usually 12 to 24 months, although it could be longer or shorter. It was actually rare for notes to be paid back, because startups usually don't have the money to do that, but there was that legal obligation to pay back the money, and it was stressful for entrepreneurs. Notes also accrued interest. So you invest $100,000 and you get 7% interest, and at the end of the year you owe $107,000. The interest rates were usually between 5 and 10% per year. So how's a safe different from a note? Two big features. One is there's no maturity, so you never have to pay the money back, and there's no interest. The fact that there's no interest actually makes it super easy to figure out the conversions later on when you're converting your safe to stock, because you don't have to have an Excel spreadsheet to calculate the interest on a daily basis. So the big advantage of safes is no maturity and no interest. Very good for investors, or for founders. The other really big advantage of the safe, and I think this is why it's become so prevalent and why it's caught on, is that the safe is super simple to use for founders. If you accept the Y Combinator form, and I heavily encourage you to do that, then all you need to do is pick the flavor of the safe that you want. And we're going to cover that in a bit. You fill in the name of your investor, and you fill in the amount that the investor's investing, and after they wire, you put in the date of the investment, and you're basically done. You save a ton of lawyer time. Lawyers used to spend a lot of time managing convertible note financings, and at the end of the day, you'd raise $500,000 and you'd have a $30,000 legal bill. That's a pre-2013 thing at this point. And the reason that it's worked so well is that Y Combinator has such a presence and such prestige in the ecosystem that I work in, that participants and investors really feel comfortable using the YC forms. So as long as you can tell an investor, this is right off the Y Combinator website, if they are familiar with safes, they will immediately have great comfort that you aren't trying to pull a fast one on them. Y Combinator strongly encourages people not to change the form. And I actually copied a part of the language from the bottom of the safe form from the Y Combinator website. So it's copyright YC. And then they say, you may modify this form so you can use it in transactions, but please do not publicly disseminate a modified version of the form without asking us first. Of course, no one asks them first. And there's a fair amount of modifications to the form, but one of my recommendations and suggestions later on is going to be, don't modify the form because it will create complexity for you and can cause investors to fret. So simplicity is a big advantage of the safe and save a lot of money on lawyers. So as I said before, with safes, you invest now and the investors get stock later. So when does the safe investor convert to stock? The safe converts when the company does its first preferred stock financing. It's often referred to as a priced round. Typically with institutional investors, venture capitalists, you've probably heard of Series C financing, Series A financing, Series B financings. That's what we're talking about when we say a preferred stock financing or a priced round. And that's the time when the safes convert. Until you do that, the safes just sit out there and the investor has no stock. When when you do that priced round, the safe is canceled and the investor gets a same or very similar type of preferred stock to the stock that the venture capitalist is getting. And there are 4 types of Y Combinator safe. I referred earlier to different flavors of safe. So if you go to the Y Combinator site, you'll see a form of safe for a discount, a valuation discount, but no valuation cap. You'll see a form for a valuation cap but no discount. You'll see one for no valuation cap or discount, but with a most favored nations provision. We call it an MFN provision. So those are the 3 ones you'll find on the YC website. You won't find the 4th one, which is a form for a valuation cap and a discount. I'm actually not sure why YC doesn't have that up there, because a lot of investors want both a valuation cap and a discount. So if you want that, you're going to have to ask your lawyer for it. It's not on the website for the Y Combinator website. And I'm going to talk about each of these 4 flavors of safe next. So a safe with a discount but no valuation cap. Here's where the safe investor gets a discount to the price that's going to be paid later on by the venture investors. 20% is a really common discount, although there's nothing magic about that. So you get a 20%, let's say, better deal, a better price than the later investors who buy preferred stock. So as an example, if the venture investors are investing at a $10 million valuation, the safe investor who invested earlier will convert at an $8 million valuation. So pay a lower price for the stock and we'll get more shares of stock. That's our discount, but no valuation cap. Now let's look at the valuation cap, but no discount. So here, the valuation at which the safe converts is determined by a capped valuation. I'll give you an example. So our company Exco is doing a preferred stock financing with a venture capitalist at a valuation of $20 million, pre-money value of $20 million. But investors previously invested $2 million in safes with a valuation cap of $8 million. So here, the safe investors, instead of investing at that $20 million valuation, they convert into $2 million divided by the 8 million valuation plus the 2 million that they're investing. So 2 million divided by 10, or 20% of the company. And it's important to say that that's 20% of the company before the venture investors get their shares. So immediately before the VC cash investment, these safe investors will get 20% of the company at that point. Next, there's a form on the site for a most favored nation safe, but no valuation cap and no discount. So in this case, the safe converts at the exact same valuation or price per share as the cash investors in the priced round. But if another later investor gets a safe with better terms, maybe it's a discount or maybe it's a capped valuation, then the first safe investor gets to opt in and get those better terms. I very rarely see this form used as is. I can't actually remember a time when I've seen this one used. But the MFN provision often gets pulled out and grafted onto one of the other two forms. That's not ideal for a founder, but I do see that happening. So this one you won't see very often. And finally, this one I do see fairly often, which is a valuation cap and discount safe. For some reason, YC has not made this available. Here, the investor gets the lower of the capped valuation or the discounted valuation. So whichever formula gets them the lower price and more shares, that's what they get. So this is the best for the investor and the worst for the founder. So what's better? If you're a founder trying to figure out which form to use, do you want to use a valuation cap, or do you want a discount? Hopefully you can avoid using both. It all depends on the pricing of the future priced round. But in my experience, typically founders are going to be better off with a discount and no valuation cap. And that's assuming that a typical discount of say 20% is used. However, sophisticated investors are almost always going to negotiate for a valuation cap. And the reason is that they don't want to invest in an early stage company with a lot of risk and then only get a 20% break down the road. It may be many months, it may be a year or 18 months before you actually raise your priced round. And you may never raise your priced round. You may not make it. Not every startup ends up making it. So investors who are savvy do not want to give you money at a very early stage when there's still a lot of risk and only get a 20% break in the valuation. So unsophisticated investors, maybe it's your uncle, the dentist, or somebody else who's willing, a friend or family who's willing to part with some cash, but not super sophisticated about venture investing. Sometimes they prefer a discount because they don't know how to pick a cap. They don't feel like they're sophisticated enough to do that. And they know that with a discount, they know they're guaranteed to get a better valuation than the investors in the priced round. So it really depends on the type of investor you have. But I think if you have a choice as a founder, I'd try to go with the discount safe if you can. Now, I'm not going to spend a lot of time on this, but in 2018, Y Combinator changed the form of the safe that they were using. And after that change, people began to refer to the pre-money safe, which was the one before 2018, and the post-money safe, which is the one that YC has used ever since. The pre-money safe, if you've got a valuation cap on your safe, the pre-money safe is actually better for founders. I'm not going to go into the reason for that. It gets pretty technical, but trust me, if you've got a valuation cap of $10 million, your post-money safe is going to be more dilutive to a founder than the pre-money safe that used to be used before 2018. However, I don't think people should be trying to find the old 2013 form. It's not available on the YC website anymore. And again, because Y Combinator has such a huge market presence and there's such trust with the Y Combinator forms, if you tried to use the old pre-money form these days, many years after the switch, I think you'd find that you'd have unhappy investors. So you may hear about the old pre-money form, and in some ways it is better for founders, but I think sticking to the current form is the best approach for the typical entrepreneur. YC also has on their website a document that they refer to as the pro rata side letter. And this is an optional document. You don't have to use it. It gives the investor the right to invest cash in the preferred stock round, the priced round, and maintain the investor's pro rata percentage of the company. So if they got the right, if their SAFE converted to 10% of the company before the priced round, then they can invest cash and stay at 10% after the priced round. The side letter is set up to terminate once the SAFE converts in the financing. And that's a very good thing for founders, because you don't want to have a lot of side letters sticking around when you're getting into the world of venture financing. So this is something that's up there on the website. It can be used or not, and this is what it does if you do use it. So we've talked so far about what happens to the SAFE if you do your venture financing and the SAFE converts. What if you sell the company before the SAFEs convert? I'm actually not going to go into a lot of the detail on this slide, but at a very high level, if your SAFE is still out there when you sell the company, maybe you just, maybe Google or Facebook or Meta come in and swoop in and buy you for $10 million. In that case, the SAFE will give the investor a better deal than your other common stockholders get at the time of the acquisition, and it's similar to what I showed you before. So a discounted SAFE is going to get a discounted valuation and get a better price, and the valuation cap SAFE is going to if Google is paying a huge price and the valuation cap is very low, then the valuation cap SAFE will give the investor a big bump. But you really, I'm not going to get into the weeds on this one. So now let's talk about some strategies if you're using SAFEs and some mistakes to avoid. The most important thing is I do encourage you to use the SAFEs from the YC website, and it's super easy to find it. Just Google Y Combinator or Google Y Combinator and SAFE, and you will immediately, very easily find the place on the YC website where you can pull down these forms. Try to avoid investors who want to change or edit the documents. This, I said earlier in the presentation that one of the beauties of the SAFE is that you can work with it without a lot of help from expensive lawyers like me. On the other hand, I often see situations where a client comes to me and they've got 5 SAFE investors and 3 of them have sent comments on the document. And now we've got a 3 or 4 ring circus where I'm having to make comments from multiple investors and talk to investor 1 about the changes investor 2 wants and investor 3 with both of them. And that's where the legal bills really start to climb and where the complexity can become tremendous. So use the YC forms if you can, and I would strongly encourage you to push your investors not to make changes to the forms other than to drop in the investor name and drop in the amount. Actually, while I'm talking about the investor name, that's one of the things that you don't need a lawyer for this, but in many cases, investors will invest through, you may be getting $100,000 from Mike Sullivan, but you don't know whether Mike Sullivan's going to invest through the Mike Sullivan Trust or through, MJS, my initials, LLC. So it's super important to, once you have an investor who's willing to invest, ask them, are you investing through an entity? And if so, give me the exact spelling of that entity's name. That'll save you some expense down the road with lawyers when it comes time to convert the SAFE. So get the legal name of your entity when you do your SAFE financing. Another tip is, if you can, avoid the most favored nation provision, even though it's up on the YC website. I'll give you an example of what can go wrong if you adopt an MFN. The MFN says whenever you do a new safe, you have to show the first investor the terms of the next safe, and then give them the chance to look at it and decide if they want the better deal. Well, that means that every time you do another safe, you're going to have to go through the process of delivering it to the prior investors and going through the process of asking them, do you want these terms or not? Maybe you're just keeping the same terms, but you're still going to have to go through that process. And it does kind of eat into the beauty of the safe, which is its simplicity. So if you can avoid MFN, I urge you to do that. I'd also urge you to avoid the pro rata rights side letter if you can. It's not a deal killer if you have to start handing these out. I have some investors that hand them, some companies that hand them out like candy when they do safes. They their first investor gets one, and then the next investor gets one, and pretty soon they feel like they have to give it to everybody because otherwise they're treating different investors differently. But avoid pro rata rights if you can. The nice thing is the early YC safes did not terminate, the pro rata rights provisions did not terminate with the safe conversion. Now they do. So it's not terrible if you have to sign up to these, but if you can, I would avoid the pro rata rights side letter. And then lastly, keep really good records about the safes that you have that are outstanding. Keep records of the safe investor, the amount invested, and the valuation cap and valuation discount. It can be really confusing and messy if a company does a financing and doesn't account for the conversion of a safe that was outstanding. That would be the, it's bad enough if you just have sloppy records about the safes that are outstanding, but if you somehow forgot to mention that one was out there and then you do the venture financing and it turns up later, that can be a huge problem. So those are some tips from an expert on what to do and what not to do. And with that, I'm going to turn it back to Alex in case there are questions to field.
Excellent. Thank you so much, Mike. That was super informative. If you will have you keep your screen share up, so then, because we do have quite a few questions, just in case you want to go back to any of the slides.
Great.
So I will get started. The first question that we got was when you were talking about modifying the forms. And so the question comes from Rescale Lab, and it's, would you recommend modifying the form for startups incorporated in a jurisdiction outside of the US, dealing with investors that are also outside of the US?
That's a good question. Preferred stock is a US concept. Most of the companies that use safes are incorporated in Delaware. And preferred stock is a concept that exists in Delaware and California and other states. If you're outside the United States, then you probably are going to need to make some slight modifications to the form to account at least for that. And so what I said earlier was you probably don't need a lawyer if you're using a safe, or it's not mandatory. If you're outside the United States, then you probably do want to have a lawyer look at the form and make sure it works for your jurisdiction. And I've seen other jurisdictions use their own form of safe. So I do a lot of work with Australian companies, and I know there's an Australian form of safe that I've seen. I recognize it. I recognize that the DNA came from the Y Combinator safe, but it's been tweaked. So yes, I would recommend some changes, and I'd recommend going to your local lawyer to help with that.
Great. Well, actually, so I'm going to ask another question that piggybacks off of that from another one of our people on the chat. So Justin Girotti, he asked, how do you convince investors outside the US, for example, Australia, to use safes?
Well, I go back to something I said during the presentation. What I typically do inside the US when I encounter investors who aren't familiar with the SAFE is I try to educate them on just how trusted Y Combinator is and how many financings are getting done based on the SAFE, and that it has really become the market dominant form of security for startups. And it's probably going to be even harder outside the US. But I still think that's the best strategy, is you just say, this is something that is used in the worldwide tech and, you know, again, Silicon Valley in air quotes world. So if you're a tech company, even if you're outside the United States, then I think the SAFE is still a good thing to use. And again, you want to point to Y Combinator as this trusted kind of trusted source for a document for financings.
Great. And I'm just going through the questions and keeping them all in kind of the same bucket as best I can. So another follow-up question to that is from Jonathan Handel. Can a US co use safes with Canadian investors or international investors as well?
Yes. So that's actually quite easy, because the US company with a foreign investor is still going to be issuing US stock to that foreign investor. If you're Canadian or Slovenian or Japanese, you're still going to get a US SAFE, and when the SAFE converts, that investor from overseas is still going to get preferred stock of a Delaware company. There may be securities laws in that country that that need to be followed, and that reminds me of one more tip that I should have put on my tips for the wise, which is you really want to make sure that every investor that you're selling to is an accredited investor under the SEC's rules. And that means that the investor, if they're an individual, that they have $1 million or more of assets outside of their home. You can also be accredited by having $200,000 of income or $300,000 with your spouse over the past 2 years and expect the same in the current year. But most people get accredited because they've got $1 million of assets. If you take money from a non-accredited investor, it can cause huge problems later on, and it can screw up the future venture capital financing. And so my antenna always goes up if I see a SAFE from a company and it's for $5,000. That makes me worry that, okay, that investor didn't have a lot of money to spare, and maybe it's somebody who doesn't meet the accredited investor standpoint. So that's a tip for US investors. And I would say typically your basic startup is not going to worry too much about the Canadian securities laws. If they're taking money from a Canadian investor, they're going to, startups have to pick their battles, and they're probably not going to hire lawyers to go run down the securities laws of every country where there's an investor. But do be aware that there are securities laws in every country, and they have to be followed.
Okay, great. So I'm going to ask another question that, a follow-up question to that was actually, what are some of the problems if you take money from unaccredited investors in a SAFE?
Yeah. So every time you take money from an investor, you have to have what's called an exemption from the securities laws of the United States and the various states. Because if you don't have an exemption, then you basically have to do an IPO, and that would be a ridiculously burdensome thing for a startup. So you have to find an exemption from that burdensome process with the SEC. And the most common exemption that everybody uses is Reg D, and it's Rule 506 of Reg D. And I'm going to simplify here, but if you have even a single unaccredited investor, then to do that Reg D 506 exemption, you're going to have to create a really long and burdensome business plan. It'll cost you, $50,000, if not more, with lawyers to do it. Nobody wants to do it. It will freak out your future investors if they find out that you have sold stock to an unaccredited investor. So the legal answer is, if you have an unaccredited investor, it will taint your future venture financing, and it will force that financing into a really burdensome structure that nobody will want. The kind of practical reason you don't want unaccredited investors is that it's going to freak out your future VCs, and you don't want that. You definitely don't want that. So really try to avoid unaccrediteds. The SEC's rule isn't that you have to be perfect. It's just you have to have a reasonable belief that the person was accredited. And embedded in the safe form is a representation from the investor that they are accredited. Now, most investors don't read that boilerplate. So, but it is there. There is a statement that if they sign the safe, then they're committing that they're accredited. But you have to have a reasonable belief that they're accredited. And again, if you're your buddy who's a young, right out of college, investing $2,500, that's probably somebody where you don't have a reasonable belief in accreditation.
So I'm gonna combine a bunch of questions on this topic as well. And I think what we'll do is then wrap up this topic and move on to some of the other questions that we've gotten. But in general, so maybe you can talk about the round that the safe agreements are typically used. So is it friends and family round? And to go and split that up as well. If you do want to raise from non-accredited investors, but also have a safe available, is there a way that you can execute that? And with foreign investors, how do you verify that they are accredited? Or do you have to?
Yeah. So if you're really forced to take money from unaccredited investors, then what you want to do is make sure that that is in a totally separate financing from your safe financing. And the SEC has rules about when two financings are combined for purposes of that. Like, you don't want the unaccredited investors from financing one to be combined with the safe financing, because now you've tainted the safe financing. So this gets into some complex SEC rules, but you want to have it separated in time. There's a safe harbor that if the two financings are separated by 6 months, then you're okay. So the more time you can put between the unaccredited financing and the accredited financing, the better. It's also a positive if you use a different form of security. So maybe you sell stock to the unaccrediteds and you sell the safe to the accredited investors. This when you start trying to figure out these kinds of issues, you really do want a lawyer involved. But it is possible, but those are some guidelines. With the overseas investors, you may not have to worry about it at all, because overseas investors have a separate way, a separate exemption. It's Regulation S. The SEC and the states really don't have a lot of jurisdiction over foreign investors investing in U.S. companies. So you may find that you've got an exemption for overseas investors, even if they are unaccredited. But definitely get a lawyer involved if that's your future path.
Okay, great. Thank you. And so we're going to get into some more of the specifics of the safe, like in terms. So one of the questions that we got from Todd Failer, I don't know if I'm saying your name right, I apologize, Todd. Could you explain more in which circumstances a founder would ever want to take a valuation cap if the cap agreed to is far under a future valuation, say 10 million cap, and 100 million valuation. That seems like a bad deal for the founder.
Right. Yeah, that's exactly right. So why would a founder ever want to use a valuation cap, especially a low valuation cap? The answer is because it's the only way you can raise money at that point from that particular investor. If you can get away without a cap, then you should. And if you have to use a cap, then you should use the highest one that you can get away with. And what a lot of companies do is they start out with a safe with a relatively low cap, and they move as they begin to make progress and de-risk the company, then the valuation cap goes up. I see that a lot. So that's a really common approach. Start low and get as high a cap as you can, and then try to push it higher as you make progress. I'm asked a lot by really early entrepreneurs who don't have any experience at all with valuation caps, and I frequently get asked, Mike, I need to raise my first money. I think I've got an investor who wants to invest. What valuation cap should I use? And then I always say, well, I don't know. I'm a lawyer. I'm not a valuation expert. And then I know enough that the next question is going to be, but Mike, come on, give me an answer. So what I often will say at that point is that higher than $5 million, if you're at that stage, is probably tough to defend. If you're a really, really early stage investor, if it's your entrepreneur, and if it's your first time raising money and you don't have a big network of investors, then more than $5 million is sometimes tough to defend. I'm shooting from the hip on that one, but that's what I've often said to clients or potential clients when I'm asked that question.
Great. Okay, if a company sells for less than the amount of capital invested across all rounds before a SAFE converts, where does the SAFE note participate in the liquidation order? And that's from Richard Harum.
Okay, I know Richard, so that's a really good question. I should have covered that in my presentation. So the current form of Y Combinator SAFE says that it is on a par with preferred stock, and so what they mean by that is that debt comes first. So if you have obligations, maybe it's obligations to employees, maybe it's money you've spent for hardware, maybe it's money that you took on a convertible note from an investor. Those are all forms of debt, and debt comes first above stock when you are dealing with liquidation preferences. So if you haven't converted the SAFE and the company needs to dissolve, then the debts come first, notes, employee obligations, other general obligations that you have, and then the SAFE comes next. And the SAFE comes before any common stock that's out there. You probably are not going to have preferred stock at that point. If you did, it would be on a par with preferred. So to really simplify, it's debts come first, then the SAFE comes next, and then common stock is last.
Excellent. Okay. If an investor is willing to do a SAFE, but is also willing to participate in a loosely pending priced round, is it better to hold off on the SAFE and just wait for the round? And second question is it frowned upon to have a pre-seed, then seed round, or better to just go seed and Series A from an investor perspective? And this is from Matt Higgins.
All right, I'm not going to be able to hold all that in my head, so I
can do the first one.
Let's do the first question first, because I remember that one.
Okay.
So you've got an investor who's willing to invest in a SAFE, but is also saying, maybe I could also just wait and invest in the priced round.
Correct.
Which is better? What should a founder prefer?
Mm-hmm.
I think it depends in part on what the terms of the SAFE are. you probably, so I'm assuming this company is reasonably close to the priced round, or this question wouldn't be coming up. One kind of rule of thumb with startups is you take money when you can. So it could be a good idea for the founder to take the money in the form of a safe with a modest discount, maybe a 10% discount. And that way you've got the money in hand, and it's you've got the cash. I would not typically advise a company to agree to a low valuation cap in that situation if they have kind of visibility into a price round coming. It just be too much dilution. So a really modest a modest discount could make sense in that situation, or it may make sense if you're really close and you have great confidence in the price round to just wait and fold them in there. You can also do a safe with no discount at all. Maybe you have a really friendly investor and he or she is very confident that the round is coming. It's possible to draft a safe with no discount and no valuation cap. That would be the best possible solution.
Great. And then the second question is it frowned upon to have a pre-seed, then seed round, or better to just go seed and Series A from an investor perspective?
So pre-seed, I'm actually not sure what's meant by that question.
Basically, I think there's just like this new trend. I just saw on LinkedIn actually like today or yesterday about a pre-seed venture capital fund. So they're probably doing more like angel investing investments and, really early stage.
Yeah.
To try to get those companies to the seed round.
Yeah. What you got to know is, are you doing a priced round where you're issuing preferred stock, or are you doing a safe or a note? And people sometimes refer to pre-seeds, and it's not really clear whether they mean like a really low valuation priced round, seed preferred, or if they're talking about a safe or a note financing. I guess what I would say is complexity is the enemy of startups. So I wouldn't try to over-engineer your capital structure by having too many rounds, because simplicity is the friend of startups, because it makes your job easier when you're kind of working with investors. It reduces the need for legal expensive lawyers, and just overall, I've found it to be a good rule of thumb to try to keep things simple.
Great. I love that. Complexity is the enemy of startups. I mean, isn't that just life in general? But that's excellent. Okay. As a pre-seed founder, we are pretty eager for funding. How do we approach negotiating a deal for money we really need without giving away the farm, i.e. the MFN agreement? And this is from Hugal Patel.
How to avoid giving away the farm when you need money, but you're an early stage company. Try to find friendly investors who are going to be gentle with terms. That's why we have for years referred to friends and family investors. They aren't sharp-elbowed investors trying to get the last percentage point of dilution. Another strategy is that either to go with a discounted safe but no cap. Again, that's kind of be more likely with your friends and family folks as opposed to the professional seed investors that will always want a valuation cap. But if you're forced into a valuation cap structure, then don't be afraid to raise the cap as you make progress. Once you've raised a six-figure number, now you've established that you've got some credibility. So maybe the next safe can have, maybe you start out with a $5 million cap, but then you go to 6 and to 8 and to 10. There's nothing wrong with a ratcheting up of the valuation caps. It is one thing to avoid is you don't want to have the valuation cap bouncing around. So to go from 5 to 20 and then back that down to 10 and then up to 12 and then down again, that leads to complexity and also to unhappy investors when they find out that somebody else got better terms even though they came at a different time.
Okay, so we've got 4 more questions left. We're not gonna be able to accept any more questions right now, but they've all been really excellent. And I wanted to just let everybody know that this is being recorded. It will be available on the StartOut YouTube channel, probably in a few days. Probably, I guess we're coming up on the weekend, so mid next week. And Mike, the next few questions, because we want to be considerate of everybody's time, are going to be kind of, the quick fire form. So I think you'll be able to answer these questions fairly quickly. Can LLCs issue safes?
Yes, they can. Yes, they can with a little bit of modification to change the references from preferred stock to some kind of ordinary shares or LLC interest. But yes, they can with a little bit of modification.
Great. What if your unaccredited investor signed your safe saying they are accredited? Does that protect you? And I think maybe, if I may, add some question to that is, protect you in the way, will they still count as an unaccredited investor in your business and have that same effect that you've mentioned before? Yeah,
it's a good question. So you thought they were accredited, they said they were accredited, and then you found out later that they are not.
Mm-hmm.
In theory, that should not be a problem. Although if you discover they're unaccredited between the time that they invested and the later conversion of the safe, now you could have a problem where that safe is participating in that venture financing, but you now know that safe investor is not accredited. So the best fact pattern would be you only find out 2 years later after your uncle has converted and you find out that he actually didn't have $1 million after all.
Okay, so after conversion.
Right. The rule is you have to have a reasonable belief. So as long as you have a reasonable belief all the way through, then you should be okay.
Okay, great. Do you need an SEC exemption for foreign investors outside the US investing in a US-based company?
No. Well, yes, there is an exemption, and it's what we call self-executing. It's Regulation S. So as long as you have people who are truly outside the United States, then you shouldn't need to do a lot of legal work for those investors to invest in your company.
Excellent. All right. And the last question, what are the minimums per investor that don't flag as a risk for unaccredited investors?
Yeah. So everybody will answer this question a little differently. If you're a venture lawyer like myself, I would say less than $25,000. My antenna goes up a little bit. 10,000 or less, it goes up a lot. Single digit thousands, I really begin to wonder. And then I will often ask the investor to sign a detailed accredited investor certificate where they actually say, yes, I'm accredited for this reason. I have $1 million of assets, or I have an income of 200,000 for the last 2 years and expect the same in the future years. So that's my personal rule of thumb. Kind of above 25 or above, I'm usually okay.
All right. That sounds great. Okay, well, we are at the end of the webinar. Mike, this has been incredibly informative, and we are truly grateful for your time tonight and for your presentation and sharing this incredible breadth of knowledge that you have. And as a reminder, we've got more events coming up for StartOut. We posted the link in the chat, and that this is also recorded again. It's going to be on YouTube, so you can check it out. And if you had any questions that we weren't able to get to, we apologize, and hopefully you can find answers to those in the future. So thank you so much, Mike.
Thank you. Great questions. I'm glad I wasn't stumped. Really good questions from the attendees.
Yeah. This was incredibly informative, and we really appreciate you. So have a great night.
Bye, everyone.